$250,000. That is when they stop charging you for wire transfers. $1 million now, they give you a dedicated advisor. $10 million, they build investment products for you that do not exist for anyone else on the planet. And somewhere in that escalation, somewhere between the free wire transfers and the custom structured product, the entire math of your financial life quietly changes. Not because you got lucky, because you crossed a threshold that nobody told you was on the map. The question is, which side of it are you on right now? Here is what I'm going to show you. The banking system has 3 entirely different tiers of access, 3 separate product menus, and a compounding gap between the bottom tier and the top that is not measured in lifestyle perks. It is measured in millions of dollars over 20 years. The reason most people never see this is not that the information is secret. It is that the institutions have no financial incentive to explain it to you while you are still profitable to keep on the wrong menu. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. They use average return assumptions without modeling sequence of returns risk, the way BlackRock and Vanguard actually do, internally. It exposes the real weak points in your plan. I only ask for your email to send the report because I do not store your financial data on the calculator itself. Link is in the description. Now, here is the central idea I want you to hold on to through this entire video. It is going to come back every few minutes, and every time it does, it is going to mean something slightly different and something progressively more irritating. Imagine you walk into a restaurant, you sit down, someone hands you a menu, you order, you eat, you leave. Most people do this with their finances their entire lives. What they do not know is that this restaurant has a second menu. Not a better version of the first one, but a fundamentally different set of options with different ingredients available only to people who have crossed a specific dollar threshold. And then, above that, there's a third menu, that the second menu people do not know exists either. The only way to be handed the other menu is to hit the number, and the numbers keep moving. I call this the hidden menu problem. And when I walk people through it, I always watch the same face happen in real time. First, skepticism, then recognition, then a kind of quiet anger that is very difficult to put back in the box. In a few minutes, I am going to show you the tax mechanics that private banking clients above $1 million use routinely, mechanics that are completely legal, widely documented, and essentially inaccessible below a certain asset threshold. The numbers are kind of outrageous. But first, let me explain why the fees you're probably paying right now are the most expensive, quiet mistake in your portfolio, and why most people who think they have solved the fee problem have not actually solved it. There is a retired school teacher from Ohio in this story. She did everything right. 30 years of consistent saving into a 401k, rolled over into an IRA at retirement, managed by a regional broker who charged her 1.2% annually on her $400,000 account. She felt good about this. She had seen advertisements for funds charging 1.5, 1.8%. 1.2 felt almost conservative. The problem is that she was measuring the fee wrong. 1.2% of $400,000 is $4,800 per year in direct charges. Fine, right? A few $1,000s annually for professional management. Except that is not how you measure the cost of a fee. You measure it in compounding. $400,000 invested at 7% annually for 20 years grows to approximately $1.55 million with no fees. With a 1.2% annual fee and net return of 5.8%, it grows to approximately $1.2 million. That fee did not cost her $4,800 a year. Over 20 years, it cost her roughly $350,000 in wealth she simply never built. She had no idea. She genuinely thought she was paying a small recurring service charge. She was quietly paying a third of her retirement. Now here is the strange part. That same $400,000 in the same market with a fee of 0.1% ends up at approximately $1.5 million. The gap between 1.2% and 0.1% fees 11 times lower produces approximately $300,000 more in wealth from an identical starting point. Same market, same time, same money. Different price for the same service. This exists because mutual funds are structured with multiple share classes. The investor share class, the one you access through a standard brokerage account, charges more. The institutional share class, the one pension funds and university endowments use, charges substantially less. Same fund, same manager, same underlying stocks. Different price based entirely on how much capital you walked in with. And the asset threshold, where institutional share class access meaningfully opens up, where advisory fees compress from 1% down toward 0.2 or 0.3, is approximately $1 million in investable assets. Below that, you can absolutely access excellent low-cost index funds through Vanguard or Fidelity, and you should. Most of my own portfolio is in them, but here is what I want you to understand. Most people think the fee problem is solved by picking index funds. It is not wrong. Index funds are genuinely excellent, but they're still the first menu. The institutional tier is a different document entirely. Also, fee negotiation. This is something most retail investors do not know is possible. 0.75% in advisory fees at $500,000 sounds like the going rate. It is also negotiable. With a fee-only registered investment advisor, not a broker, a fiduciary, the realistic advisory fee at $500,000 is often 0.40 to 0.50%. If you ask explicitly, at $1 million, 0.20 to 0.30% is achievable. The compounding difference between 0.75% and 0.30% on $1 million over 20 years is approximately $340,000 in preserved wealth. One conversation, worth more than most tactical investment decisions made in a given year. By the way, hit subscribe if you like the content, otherwise YouTube's algorithm may genuinely never show you my videos again. The algorithm makes promotion decisions the same way banks do, based entirely on signals of loyalty and engagement, which is either funny or depressing, depending on how you feel about systems this week. Now, I want to introduce two people. Call them David and Marcus, cousins. Both started working at 28, both earned similar income somewhere in the low six figures. Both contributed the maximum to their 401ks, both invested consistently, both crossed $1 million in investable assets around age 40. Same starting point, same discipline, same market. At the moment they crossed 1 million, their financial lives divided. Not because of anything either of them decided to invest in, because of which tier of the financial system they ended up operating in. David stayed with his existing brokerage, good low-cost index strategy, no complaints. By any retail standard, he was doing everything right. Marcus got a call. His private bank had been watching his asset level, and when he crossed the threshold, they offered a different conversation. They handed him the other menu. I am going to come back to them at the end of this video, and the number is not what most people guess. But everything between here and there is what explains it. Stay with me, because this next part changes everything. Here's what nobody is telling you about what is actually on the second menu. When most people hear private banking, they picture a nicer waiting room and a relationship manager who remembers your birthday. And at the Chase private client level, which starts at $150,000 in qualifying deposits and investments, that is largely what you get. Wire fees disappear, no ATM surcharges. Someone answers when you call. That is genuinely useful. It is also the free breadsticks of the second menu, not the actual food. The actual food is the products. There is a legal designation in United States securities law called an accredited investor. To qualify, you need $1 million in net worth, excluding your primary residence, or $200,000 in annual individual income, $300,000 jointly for the past 2 years, with a reasonable expectation of the same going forward. Approximately 13% of American households currently meet these criteria. What this designation unlocks is access to investment categories that are explicitly unavailable to the other 87%. Private placements, hedge funds structured under Regulation D, private real estate syndications, direct lending funds. These are not niche or exotic instruments. Private equity globally is a $30 trillion asset class. Private credit in the United States alone has grown to approximately $1.7 trillion. And the historical return profiles are not trivially better than public markets. Cambridge Associates data shows top quartile private equity funds have averaged roughly 14 to 15% annually since the 90s. The S&P 500 over the same period has averaged approximately 10 to 10.5%. 4 to 5% of additional annualized return sounds small. On $1 million compounded over 20 years, it is the difference between approximately $6.7 million and $10.8 million. That is $4.1 million that retail investors are legally locked out of. Not because the products are inherently dangerous, because securities law draws a line at $1 million of net worth and says, above this line, you are presumed sophisticated enough to evaluate these risks yourself. Now, there is a tier above accredited investor that is even less discussed. It is called a qualified purchaser. The threshold is $5 million in investable assets. At this level, access to specific categories of hedge funds opens fully, including funds that cannot be offered under the standard accredited investor framework. Direct co-investment in private deals alongside institutional money becomes possible. And certain municipal bond auctions, the ones where large pension funds and foundations participate at pricing that is simply not available in the open retail market, become real options. The retail investor does not even know these auctions exist. Not because the information is hidden, because the invitation was never sent. They hand you the other menu. Every time you cross the threshold, the document changes. And you did not know the previous document was incomplete until you see the next one. At $10 million, there is a third menu: JP Morgan Private Bank, Goldman Sachs Private Wealth Management. Goldman's official minimum is $10 million, but the meaningful senior conversations generally do not happen until closer to $20 million. Citi Private Bank has an entry point of approximately $25 million. At these institutions, the product distinction is not a wider selection, it is authorship. There is a story I have heard from multiple people inside wealth management. Over the years, the names change depending on who tells it, but the core is always the same. A fund manager was asked by a client with $2 million under management what the practical difference was between his tier of service and the service offered to someone with $50 million. The manager thought about it for a moment. Then he said, "With you, we discuss which products fit your goals. With them, we build the products. Build them, not select from them." At the top tier, investment vehicles are structured specifically around the tax situation, liquidity timeline, and estate planning goals of a single client. The legal entity, the leverage terms, the exit provisions custom. Below that threshold, you are a consumer of financial products. Above it, you are the specification. Imagine explaining that dynamic at a dinner party. You say, hey, at a certain wealth level, banks literally create investment structures for you. Someone goes, that sounds like it should be illegal. You go, it is extensively regulated, actually. They say, well, the SEC should look into it. You say, the SEC helped design the framework that makes it possible. Then someone at the end of the table asks their advisor whether they should be in a target date fund. Anyway, now the tax layer. This is the part that, once you understand it, makes everything else in this video feel almost quaint by comparison. ProPublica published an analysis in 2021 based on actual IRS records they obtained, showing that the 25 wealthiest Americans saw their combined wealth grow by approximately $401 billion between 2014 and 2018, and paid roughly $13.6 billion in federal income taxes over that period. That is an effective rate of approximately 3.4%, not 3.4% of income, 3.4% of actual wealth growth. The mechanism behind this is not fraud. It is not a loophole in the pejorative casual sense. It is the predictable consequence of how income is defined under the tax code, combined with a specific borrowing strategy that is economically rational only above a certain asset threshold. The strategy has a name. It is called buy, borrow, die. Deliberately blunt, because the concept is deliberately simple. You buy appreciating assets, equities, real estate, private company stakes, you do not sell them because selling is the taxable event. You borrow against them instead. Banks will lend you money at rates between 3 and 5%, secured by your investment portfolio. These are called securities-backed lines of credit. You live on that borrowed cash. The loan proceeds are not income. They are not a taxable event in any form. Your assets continue compounding. And when you eventually die, your heirs inherit those assets at current market value under what is called the stepped-up basis provision. The embedded capital gain, the one you borrowed against for years, possibly decades, simply disappears. It is never taxed. Here's the arithmetic on a real scale. You buy $5 million of diversified equities. Over 15 years, it grows to $12 million. Unrealized gain, $7 million. If you sold at a 15% long-term capital gains rate, you pay roughly $1.05 million in taxes. Instead, you borrow $4 million against the portfolio at 4% annual interest. That is $160,000 per year in interest, your cost of liquidity. You keep the $4 million. Your assets keep compounding toward $12 million and beyond. You never trigger the gain. You die. Your heirs inherit at $12 million with a reset cost basis under current tax law. The $7 million gain? Gone. Never taxed. The loan is repaid from estate assets. The math worked in your favor for 15 years and then closed cleanly. The bank offering this at 4% is not doing you a favor. They are making a commercial decision. Your collateral is liquid, easily valued, and low risk for them. The interest income is consistent. Above $1 million in investable assets, you can access securities-backed lending in some form. The rates and terms improve meaningfully above $5 million. Above $10 million, banks compete for the lending relationship because the interest income at that scale is a meaningful business line. Below $500,000, the terms are worse. The minimums are higher. Many private banks will not initiate the conversation because the loan size is not worth the operational overhead. The product exists, technically, but the economics do not work the way they need to for the strategy to be worth executing. You think the problem is not having enough money. Actually, the problem is not knowing what money unlocks at each level. Those are different problems. One is about accumulation, the other is about architecture. And the architecture problem is solved by understanding the thresholds before you hit them, not after you have spent a decade on the wrong floor. Let me make this concrete. Here is a scenario that I think is within range of a lot of people watching this right now. You are 43 years old, $850,000 in investable assets, roughly $550,000 in a taxable brokerage account, and $300,000 in retirement accounts. Income of $160,000 per year. You max your 401k contributions, you hold a low-cost index fund strategy, and you are genuinely doing most things right by any textbook standard. But you are paying 0.80% in advisory fees on your taxable account. You hold an S&P 500 ETF, which is a genuinely good choice, but because it is a fund rather than direct individual stock positions, you cannot harvest losses at the individual position level during sector rotations. When you needed liquidity last year to fund a home renovation, you sold $42,000 of appreciated shares and paid approximately $6,300 in capital gains taxes you did not need to pay. And you have no private market allocation because you are not yet fully accredited on a net worth basis, and the relevant vehicles have not been introduced to you. Now trace the same person forward to age 60 under two different scenarios. Scenario 1, current setup, nothing changes. At 7% gross annual return, your taxable account grows to approximately $1.6 million. Your retirement accounts grow to approximately $1.1 million. Total portfolio at retirement, approximately $2.7 million. Scenario 2, you cross $1 million in total investable assets at age 46, 3 years from now, and immediately make 3 specific changes. You switch to a fee-only registered investment advisor and negotiate the advisory fee down to 0.3%. On a $1 million taxable account, that saves $5,000 per year in direct fees, which compounded over 14 years at 7%, preserves approximately $120,000 in additional wealth. You implement direct indexing on the taxable portion, replacing the ETF with direct ownership of the underlying stocks, which enables you to harvest individual position losses during market rotations. Vanguard's own research on direct indexing estimates 0.75 to 1.1% in annual after-tax return improvement through this mechanism, using a conservative 0.9% over 14 years on a $1 million taxable account. That adds approximately $190,000 in additional after-tax wealth. And you allocate 15% of your taxable portfolio, $150,000, to accredited investor private credit funds paying consistent 7 to 8% annual distributions versus the 4% you were getting from your bond exposure. Over 14 years, the return differential on that allocation adds approximately $95,000 in additional compounded income. Combined additional wealth from 3 mechanical changes, approximately $405,000. Scenario 2, portfolio at age 60, approximately $3.1 million. Not $3.1 million from finding better stocks, not from taking more risk, from operating on the second menu with the tools that second menu makes available. That is the gap. That is what the threshold unlocks. And that is the difference between David and Marcus. 20 years after that fork at 40, David's portfolio is worth approximately $3.4 million. Genuinely excellent. By any retail standard, he should be satisfied. He optimized the menu he had consistently and intelligently for 2 decades. Marcus is at $5.1 million. The $1.7 million difference did not come from Marcus picking better stocks. It did not come from taking on more volatility. It came from fee compression compounding over 20 years, from direct indexing tax savings accumulating annually without effort, from a private credit allocation that earned 3% more annually than David's bond position over the same horizon, and from one strategic moment where Marcus used his securities-backed line of credit to avoid selling appreciated shares at a perfect inflection point, preserving roughly $90,000 in capital gains taxes in a single transaction. The system handed Marcus to the other menu. He ordered from it consistently. That is the entire story. No secret insight, no superior intelligence, just different tools, activated by a threshold, deployed by someone who knew to ask for them. Now, 3 things you should actually take from this, calibrated specifically to where these thresholds sit. First, if your investable assets are between $250,000 and $1 million right now, your single highest leverage move is to locate a fee-only registered investment advisor, not a broker, not a commission-based financial planner, a flat fee or AUM fee fiduciary, and negotiate explicitly on the advisory rate in your first meeting. 0.40 to 0.50% at $500,000 is achievable if you ask directly. The difference between 1% and 0.50% on $500,000 over 20 years is approximately $175,000 in preserved compounding. That outcome comes from one meeting, one question. Most people never ask because they do not know it is negotiable. Second, when you cross $1 million in investable assets, the 2 specific conversations to initiate immediately are about direct indexing on your taxable account and access to a securities-backed line of credit. If your current advisor does not raise direct indexing proactively when your taxable account crosses $500,000 in value, that is information about whether they are operating at the tier your situation actually requires. Advisors who work at the relevant level bring these tools up without being asked because their clients expect it. Third, treat the $5 million qualified purchaser threshold as an explicit architecture milestone in your financial plan, not an incidental accumulation number. The question is not only how to reach $5 million, the question is what your portfolio structure, legal entity setup, and tax position need to look like at $5 million to actually unlock what that threshold makes possible. This is a planning question that requires a tax attorney and an estate planner sitting alongside a financial advisor. Ideally, before you arrive at the number, not after. People who design toward the threshold extract significantly more from crossing it than people who arrive there accidentally and spend the first year figuring out what changed. Lazy investing built more fortune than crypto. Memes. The people who built it quietly, We're not trading faster or working harder or finding information nobody else had. They understood which level of the restaurant they were operating in, and they asked for the other menu before the waiter decided whether to bring it. The annoying truth is that the system will eventually upgrade you on its own timeline once you already have enough money that the upgrade matters slightly less. That is how the system prefers it. So ask before they decide you are ready. Go ask your banker what tier you're in right now. Watch how long it takes them to answer.